What is going on, traders? We need to talk about what's going on in the market, why it's aggressively making a move below June lows at the moment, especially since jobless claims came out to a 5-month low. On the surface, you might say to yourself, hey, jobless claims are going down, which means that unemployment is going down. Isn't that good? Shouldn't the market rejoice at that news? However, not when the Fed is actually trying to break the labor market. Yes, you heard that right. The Fed is trying to break the labor market. Now, this isn't some tinfoil hat conspiracy, saying that, hey, the Fed is trying to do this and make some unsubstantiated great reset type of claims. So we're going to get into why the Fed is trying to break the labor market, why the market is tanking on good jobless claim numbers, and stick around to the end of the video to see how I just bought Tesla at a 55% discount from highs and what dividend paying stock I just invested in that gives you a better yield than any treasury that's on the market right now. Let's get right into it. So as I said, the jobless claims numbers hit a 5-month low. The drop to 193,000 was below the estimate of 215,000. How did the market react? The market reacted by tanking 3% currently as of the time of this recording. I did a similar video back when the last jobless numbers were released showing a decline in jobless claims. Now, the Fed has a dual mandate that is explicitly stated by Congress. Actually should be called a triple mandate. Maximum employment, stable prices, and moderate long-term interest rates. Now, two of these things are at odds right now, the maximum employment part and the stable prices part. Obviously, they need to raise interest rates in order to get inflation under control. And they've been raising rates aggressively. We got a 25 basis point rate hike in March. We got a 50 basis point rate hike in May, and then 375 basis point rate hikes in a row. This is the most aggressive Fed in 42 years. The problem with this is not that they're raising interest rates. They should be raising interest rates. However, they should have done this way sooner in 2021 when we were reopening and the economy was strong and we had the hottest GDP ever. That's when we should have started raising rates in a strong economy. Now that employment hit almost 9%, we are playing catch up. And so the Fed is having to scramble to make itself look good and keep its credibility, or whatever credibility it currently has, and institute these aggressive rate hikes. The problem is that these don't actually get reflected into the economy for potentially years to come. They are essentially acting precipitously here and oversteering because they didn't act when they should have. And so aggressive rate hikes like this, once they finally start reflecting into the economy, then you get what is called a hard landing, because at this rate, something is going to break. They are not giving these rates a chance to breathe. And I don't know if they should. I don't really know what the answer is here besides going back in time and raising rates in 2020 and 2021. And they are using a very blunt tool to do so. So, in short, for those of you that aren't familiar with why interest rate hikes slow down the economy, just think about it like this, okay? When you have these interest rate hikes, you're essentially making the cost of buying things more expensive, which is what you want to do as the Fed. The Fed has control or some control over consumer demand. So if they keep raising rates, then cars are going to be more expensive. Home loans are going to be more expensive. Big purchases like that are definitely something that the Fed is interested in curbing, right? Because you see those numbers hit the economy. And then obviously the cost of borrowing money for other things, such as starting businesses or growing businesses, becomes more expensive. So people do less things in terms of a gross domestic product, and they buy less things, right? What happens when people buy less things? Well, when people buy less things, that means that company revenues, these earnings here that you see, these earnings start declining. And what happens when earnings decline? Well, when earnings decline, let's just say these are employees, the company makes less money. And so now these lowly employees here have to go, right? Because there's no need for them if the company's not growing. That is why the Fed boosts their Fed funds rate when they're trying to curb inflation. Now, they can't tell you outright that, hey, we're trying to get people fired or laid off, or we're trying to boost the unemployment rate. But look at these gray bars here are all the recessions we've had in the US. Look what happens to the unemployment rate right before and during a recession. always, the unemployment rate always starts ticking up from a low, right? You see this with every single recession, every single one. The unemployment rate starts ticking up. Why is that? Well, because the Fed is doing that. The Fed is raising rates in order to curb inflation and stabilize the markets. That is the main tool that they have, which unfortunately is blunt. And so, what they're trying to do, as you see here, the unemployment rate is still low, is they want this to go up in the same way that it went up here and here and here and here and here. And that is why numbers like this don't fare well for the markets. When the markets look at this, they're like, holy shit, we need unemployment to go up so the Fed stops fucking around. Otherwise, the Fed is going to keep raising rates. November comes around, they're going to do another hike and another hike. And when the Fed raises rates too aggressively, things break, and the market knows this. So because based on the jobless claims, it looks like unemployment is still low, the Fed's rate hikes are still not doing their job, which means that the Fed will likely continue overcorrecting. And I've talked about this before, but the last shoe to drop, in my opinion, for this bear market, where we'll finally see a capitulation blow, is when the forward earnings for companies are actually lower and they hit levels that we typically see in recessions, right? Right now, we're actually at around an average. The forward PE ratios for the S&P 500 is not elevated. This is what we typically see around, the 16 area. But when these forward PEs start dropping because of what I just described, because of aggressive Fed rate hikes leading to less spending, leading to unemployment going up, leading to then affected company revenues and affected company earnings. That is what's going to be the final blow. And you see Apple down here, very atypical and unorthodox for Apple, almost a 6% down day here on Apple. When was the last time you've seen Apple down 6%? And Apple is the biggest holding in both the S&P 500 and the NASDAQ. So Apple can, and this was trading at $80 before the pandemic. So companies like Apple, Microsoft that really have been holding the market up, those could be what the finally does in the indices, and we come down to at least these pre-COVID highs on the S&P 500 and on the NASDAQ, which is another 6% down for the S&P, another 13% for the NASDAQ. And this is why I sold cover calls on my shares of Apple, Tesla, etc. I'm actually up 87% on this Apple cover call that I should probably close. It expires in December, but I should probably close this and take profit. All right, and here's how I bought Tesla at a 55% discount. Tesla has seen a 7% drop today. I ended up selling the 193.33 cash secured put. The reason that this pricing is unorthodox is because of the split. All the options prices had to split by the same order of magnitude that the shares did. So that's why you see uneven options pricing. They will eventually resolve themselves, but the current open contracts that were open before the split now have this uneven pricing. But I essentially sold that 193.33 put on Tesla, and I sold it for $10.60. Now, what that means is that if I get assigned on Tesla, then my cost basis on Tesla is going to be 182.73. That is going to be my cost basis on Tesla if I get assigned. If I don't get assigned, then I get to keep $1,060 for every contract that I sold on Tesla. This is called a cash secure put. If you're not familiar with this, look it up. So 183.33 is about a 55% discount on Tesla from highs, and about another 30 some odd percent from here, about 31% from here. And if it doesn't drop to my level, I keep the money. This is essentially, to me, this is free money. This is getting paid to buy Tesla cheaper, or for the opportunity to buy Tesla cheaper. The other stock that I ended up adding to is XLE. Now, the reason that I added to XLE yesterday is, one, because of technically where it sits. It's now at the bottom of this trend line. Two, we tend to see a boost in oil right before a recession. Now, oil is still somewhat elevated. However, the problems with oil aren't getting any better. You still have what's going on between Russia and Ukraine. The Saudis already said that they're not going to boost production. You have winter coming, which tends to consume a lot of energy. You also have the potential reopening in China. So at this technical level, I was okay buying XLE, which is the energy sector of the S&P 500. But also, I don't need it to make money immediately. It currently pays out a 4.2% dividend yield. That means that if you buy XLE at these prices, you're getting 4.2% a year on your money, regardless of what the stock price does. And that currently, if you look at bond rates, that currently is better than any single treasury at the moment. The 3-year treasury gives you about 4.2% at the moment. However, you're not owning equity in any company. You're just getting the 4.2% as a yield versus owning XLE and not only getting that 4.2%, but you also get an ownership in the company and there's a potential for the stock price to rise. But even if the stock price tanks, you're still getting 4.2% guaranteed on your money, right? So I like where XLE is here. Obviously, this is not financial advice. Look into your own investments and whether you agree buying energy at these levels. But yeah, we're essentially getting it 23% down from highs. And if you're wondering what's in XLE, you obviously have the legacy energy companies, Exxon, Chevron, etc. But then you also have some of the smaller companies that have been making a lot of growth recently, like Marathon, Occidental, which Warren Buffett just bought more shares of, and Devon Energy as well. So take a look at what's in the ETF. If it works for you, you like the dividend yield, then yeah, might be something that you want to look into. Anyway, traders, that is it for this video. Hopefully you got something out of it. Hopefully you understand why something like a declining jobless claim in this market environment can actually lead to jitters in the stock market as we currently see. It's because the stock market now thinks that the Fed has to continue to act aggressively because what they're doing hasn't worked. However, what the Fed is doing will take time to see. And unfortunately, when you have inflation that's running so hot, the market, the economy, the politicians, the people, everybody really doesn't have that kind of time, right? So the Fed will continue to act aggressively, in my view, until something continues to break. Hopefully, it's not that hard of a landing because that affects real people materially on the ground, and nobody wants to see that. But let me know your comments down below. Let me know what you think of the jobless claims, what you think of the Fed. Are they going too hard, too soft? What do you think they're going to do in the next Fed meeting, November 2nd? Let me know if you guys are looking at any stocks at these levels. Would love to hear from you. If you guys want to learn how to sell cash secure puts, you want to see what my analysis is every day, what stocks I'm adding to the long-term portfolio, what options I'm playing, etc. Sign up, link is in the description below. Only a couple spots left for September. Otherwise, they will likely reopen at some point in October. But book a free call with an ambassador. Doesn't cost you anything, so do it. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.